Now, some of the retail investors always find it a bit tricky to identify if whether a company is undervalued or overvalued. And this goes for both companies that are profitable and to those that are not yet profitable. Because, for instance, you can't go and use a PE ratio on a company that's not yet profitable. It does not make sense, or you can't. That is why you always see that for those companies that are not yet profitable, you don't even see the PE ratio, because you can't use the PE ratio on a company that's not yet profitable. So what is it that you use on companies like that which are not profitable? What is the ratio, or which kind of a ratio do you use to identify if the stock it's undervalued or overvalued? And to those that are profitable companies, on the PE ratio, how do you determine if whether that company is overvalued or undervalued? Well, on today's video, guys, you are very lucky, because we'll be discussing just that. So at the end of this video, you should be able to identify if whether a company is undervalued or overvalued, and this goes to if whether a company is profitable or not yet profitable. So stay tuned and watch this video until the end, because I definitely think that at the end of this video you are going to be very excited, because each and every company out there that's listed on the stock market, you will be able to sort of like use some of these ratios that I'll give you here to identify if that stock is undervalued or overvalued. Otherwise, without going any further, please note that I'm not a professional financial advisor. All I'll be saying here are just my opinions, and if you seek professional financial advice, you already know what to do, and that is you need to go and consult the professionals. Otherwise, if you like the content that I'll be giving you on today's video, please don't forget to hit that likes button, comment, and to those that are new, don't forget to hit that subscribe button and click or press that notification bell, so that every time I release a video here on this channel, YouTube can notify you. Now, without a waste of time, what are the ratios, or what are the two ratios that I usually use to identify if the company is overvalued and undervalued? Now, for of course the companies which are profitable, I use two ratios. I usually use the PE ratio and the PS ratio. Now, of course, with the companies that, like I said in the beginning of this year, that are not profitable, you cannot use the PE ratio, because their earnings are still negative. So for the companies that are profitable, I use these two ratios. So the PE ratio, you will know that, and the PS ratio, basically these are the two ratios that I use to value the company. And of course, there are other ratios that you can use, or there are other key terms that you can use to value this company. But me personally, I usually use these two. So a PE ratio is a price to earnings ratio, right? And this is calculated, or the formula to calculate this PE ratio is the share price divided by the earnings per share. So is the share price divided by the earnings per share. Now, the reason why, of course, you can't use it on companies which are not yet profitable is simply because the earnings per share of those companies are still on a negative. You can't use those kind of companies to calculate the PE ratio. So to those that are profitable, is the share price divided by the earnings per share. Now, whatever number that you get out of this, of course, you can use that number and go compare that number against the company you want to check, or the company you are valuing against its peers. So that is how you will identify if this company is undervalued or overvalued. If you find that this company has got a lower PE ratio when comparing to its peers or companies in its industry, then it means that that company or this company is undervalued. Whereas if you find that its PE ratio is higher than the average companies in its industry, then that just simply means that this company is overvalued, and I don't think probably it will be the right time for you to buy that company, because already that just means, or it might mean that already that company is quite expensive or quite pricey. Now, with the PS ratio, guys, you can use this ratio to identify if a company is overvalued or undervalued. But the good thing about the PS ratio is that now you can use it on both companies that are profitable and those that are not yet profitable. Now, how do we calculate, or what's the formula to calculate the PS ratio? Well, it's quite simple. The PS ratio, or the formula to calculate the PS ratio, is simply the market cap of a company. Now, market cap, usually if you just go like Google and say probably just say NEO share price or Sibanye Stillwater share price to local companies, usually you will get, even on Google, when they show you the share price, they will also give you the market cap of that company. But also you can also go to websites like Yahoo Finance. They will give you the market cap of these stocks, so you get the market cap there. So it's market cap divided by the sales, or the 12-month sales of that company. So whatever value you get, you do the same thing. You go and compare it with companies in its industries or its peers, and if that value is lower than the average companies in its industry, then it's undervalued. Whereas if it's higher than most of the companies in its industries, then it's overvalued. This is the ratio that you use to identify if whether a company is overvalued or undervalued for both profitable and non-profitable companies. So you do the same thing. So the lower the value is the better. So if the company A has got a PS ratio of 5 and the company B has got a PE ratio of 8 and they are in the same industry, it simply means that company A is undervalued when comparing to company B, when we are comparing the two. So this is how you use this ratio. So these two ratios are the ratio that you use when you want to identify if a company is overvalued or undervalued. So it's just that you can use these two ratios for profitable companies, but you can't use two of them on non-profitable companies, because like I indicated in the beginning of this video, PE ratio, you can't use it on companies which are not yet profitable. So you use the PS ratio to identify if whether those companies that are not yet profitable, if whether they are undervalued or overvalued. And by the way, I forgot to tell you, of course, the total sales or the total 12 months revenues, you already know that you get that on companies' financial statements or quarterly statements. You can easily get the 12 months total revenue or 12 months total sales of company. I'm talking about the PS ratio, because you remember the formula says market cap divided by 12 months sales or 12 months revenue. So you get the 12 months revenue from obviously the company quarterly statements, and of course the last quarter or the Q4 earnings will be the one to probably tell you the total year revenue which that company reported. So you will just go take that total revenue and go plug it in and get your answer. Otherwise, with all that, guys, I hope this video was helpful, and after this video, like I said, I hope now you can go out there and do these quick calculations and be able to identify if a company is overvalued or undervalued. And guys, always remember, it is not wise for you, especially as a beginner or as a beginner retail investor, to buy companies which are overvalued or expensive, because chances of you making some good returns on those companies becomes slim. But if you are to buy a company which is undervalued, then you have massive chances, or your chances gets better. You can be able to make some good returns in the future, which is why it's important that you make sure that you are putting your money on a stock that is at least offering you a good share price. Otherwise, with all that, guys, I make tons and tons of stock market investing videos, and before you could spare a dollar or two, or before you can put your money into some of these companies, also just do your own due diligence and make sure that at least you know where you are putting your money, so that you know at least what are the future prospects, what are the latest developments of some of these companies, which will make your at least your life when you're investing in the stock market easier. Because don't just take things that people say, even me, don't just take what I say, just go and confirm what I say, or just go and just do your research at least, so that you can be comfortable when you're investing into these stocks. Otherwise, with all that, guys, I wish you nothing but the best in your stock market investing journey. And if you're new, don't forget to hit that subscribe button and click the notification bell. And to those that are returning, don't forget to hit that like button if you enjoyed this video. Otherwise, that's all from me, and I wish you nothing but the best in your stock market investing journey, and God bless you all.